In 1980, the silver futures market experienced a phenomenon that should have been impossible. Spot prices exceeded futures prices by over 10 per ounce for weeks. This condition, called backwardation, violates the fundamental logic of commodity markets. It means buyers were willing to pay more for immediate delivery than for promises of future delivery. It signaled that participants no longer trusted the system to deliver metal when contracts matured. Today, in late 2025, silver has entered sustained backwardation not seen since that period. Spot silver in London trades at premiums of 1.50 to 2.50 per ounce above 3-month futures, a condition that has persisted for over 90 consecutive days. Simultaneously, Asian physical markets are draining Western vaults at a rate exceeding 200 metric tons monthly, the fastest sustained outflow in modern records. When the price of metal you can hold today exceeds the price of metal promised for tomorrow, and when that condition persists for months, while inventories flow in one direction across the globe, what does it signal about the system's ability to maintain the illusion that paper and physical are equivalent? For most of commodity market history, the relationship between spot prices and futures prices was governed by a simple principle called the cost of carry. If you own a commodity today, you incur costs to store it until a future date, warehouse fees, insurance, financing costs for capital tied up in inventory. Therefore, the price for delivery in 3 months should exceed today's spot price by roughly the amount of those carrying costs. This creates a condition called contango. Futures prices are higher than spot prices by an amount that reflects storage and financing. Contango is the natural state of commodity markets. It allows producers to hedge future production, consumers to lock in future costs, and speculators to profit from carrying inventory if the contango premium exceeds their actual costs. The opposite condition, backwardation, should be rare and temporary. Backwardation means spot prices exceed futures prices, implying that immediate possession of a commodity is worth more than a promise of future delivery. This can occur briefly during supply disruptions, a refinery shutdown, a transportation delay, a weather event that temporarily restricts supply. But under normal conditions, backwardation should self-correct within days or weeks as arbitrageurs buy cheap futures, take delivery, and sell expensive spot, earning the difference. The persistence of backwardation for extended periods signals something beyond temporary disruption. It signals that participants doubt futures contracts will result in physical delivery at maturity, or that physical supply is so scarce that immediate possession has value beyond normal carrying costs. In either case, backwardation reveals a breakdown in the normal functioning of commodity markets. Silver experienced brief periods of backwardation during the 1960s as industrial demand surged and government stockpiles were depleted. The U.S. government had accumulated over 2 billion ounces of silver in strategic reserves, primarily from mining production, that exceeded monetary demand after silver was removed from coinage. These stockpiles were sold throughout the 1960s and 1970s to suppress prices and meet industrial demand. When stockpiles approached depletion, backwardation appeared intermittently as physical supply tightened. The most dramatic backwardation occurred during the Hunt brothers episode in 1979 to 1980. As Nelson Bunker Hunt and William Herbert Hunt accumulated over 100 million ounces of physical silver and held substantial long futures positions, spot prices surged above futures prices. By January 1980, backwardation exceeded $10 per ounce. Spot silver traded above $50, while 6-month futures traded below $40. This extreme backwardation reflected market participants' belief that silver was unavailable at any price near the futures quote, and that the Hunt brothers controlled enough physical supply to prevent normal delivery processes. The backwardation during the Hunt episode was resolved not through normal market mechanisms, but through exchange intervention. COMEX changed rules to restrict new long positions, increased margin requirements dramatically, and effectively forced liquidation. This collapsed prices and eliminated backwardation by destroying demand for physical delivery. The lesson extracted by the market was that sustained backwardation would not be allowed to persist. Exchanges would intervene to protect short sellers and restore contango. China's historical relationship with silver provides another important precedent for understanding physical market dynamics. For nearly 500 years, from the Ming Dynasty through the fall of the Qing Dynasty, China operated on a silver standard. Chinese merchants demanded silver for exports because it was the most trusted store of value in international trade. This created persistent trade surpluses paid in silver, resulting in massive accumulation of physical metal in China. By the 19th century, Western estimates suggested China held 20 to 30% of all above-ground silver in the world. This accumulation was not policy-directed hoarding. It was the natural result of producing goods the world wanted and accepting payment in the hardest money available. The silver represented real wealth, goods exported, productivity demonstrated, value stored in physical form that could not be debased by government decree. When Western powers sought to reverse these trade imbalances in the 19th century, They did not do so through competitive manufacturing or superior products. They did so through opium exports to China, creating artificial demand for a product that drained Chinese silver reserves and reversed centuries of accumulation. The opium wars were fundamentally about silver flows and trade balances, not about drugs or morality. The historical lesson is that when one economic zone accumulates physical commodities through sustained trade surpluses, while another zone issues paper claims, the accumulation eventually creates pricing power. The zone with physical possession can dictate terms. The zone with paper promises must either deliver metal, find alternatives, or face repricing that reflects actual scarcity. The modern silver market, as evolution into a system where backwardation can persist for months, represents a fundamental departure from historical commodity market structure. This transformation occurred gradually through decisions that seemed prudent individually but created systemic fragility collectively. The London silver market, which emerged as the global pricing center in the 19th century, originally functioned as a physical market. Merchants, miners, and industrial users bought and sold actual silver bars. Prices reflected physical supply available for immediate delivery. Credit was extended against physical metal held in vaults. The system's integrity depended on the enforceability of delivery. If you sold silver you didn't possess, you had to acquire it or face default and commercial ruin. The introduction of futures contracts in the 20th century added efficiency but also complexity. The COMEX silver contract, standardized in the 1960s, allowed participants to hedge without physical transfer. A mining company could sell futures against future production, locking in prices without delivering metal immediately. A manufacturer could buy futures to secure future supply without taking delivery until needed. Speculators could trade price movements without ever intending physical settlement. This system worked as long as two conditions held. First, that futures prices remained tethered to physical reality through arbitrage and delivery mechanisms. Second, that most participants settled in cash rather than demanding delivery, allowing the paper market to remain larger than physical supply without creating delivery failures. But over decades, the ratio of paper trading to physical availability expanded dramatically. By the 1990s, estimates suggested daily trading volume in silver futures exceeded annual mine production. By the 2010s, open interest in COMEX futures often represented more silver than existed in all exchange-approved warehouses globally. The paper market had become orders of magnitude larger than the physical market. This expansion was enabled by the shift toward cash settlement. Originally, futures contracts were settled through physical delivery unless both parties agreed to cash settlement. Over time, the default shifted. Cash settlement became standard, and physical delivery became the exception, requiring special notice and procedures. This inversion meant that the futures price no longer had to reflect physical availability. It could diverge substantially as long as most participants accepted cash settlement. The London Bullion Market Association, LBMA, operates parallel to COMEX, but with even less transparency. LBMA facilitates over-the-counter silver trading primarily through unallocated accounts where customers own a claim on silver held in bank vaults, but not specific bars. These claims can be traded, lent, and leveraged multiple times. A single physical bar in an LBMA vault might back 10 or 20 claims through lending and rehypothecation. The critical vulnerability is that unallocated accounts allow banks to issue unlimited claims against limited physical backing. As long as customers don't simultaneously demand conversion to allocated, physically segregated metal, the system functions. But if allocation demands surge, banks must either source physical metal to back the claims or settle in cash at prevailing prices. This creates the same dynamic as historical bank runs. The first customers to demand physical metal receive it, and later, customers discover insufficient backing exists. The Shanghai Gold Exchange, SGE, established in 2002, represents a deliberate rejection of this paper-heavy structure. SGE requires physical settlement within 2 business days for all spot contracts. No unallocated accounts are permitted. Forward contracts exist, but they must be settled through delivery of physical metal, not cash. This design reflects Chinese policymakers' understanding that allowing paper claims to vastly exceed physical backing creates manipulation opportunities and systemic instability. For years, this structural difference between Western paper markets and Eastern physical markets was manageable. COMEX and LBMA set global prices through high-volume trading. SGE prices track those benchmarks with modest premiums or discounts reflecting local supply conditions. Physical metal flowed between markets to arbitrage price differences. But this equilibrium depended on Western markets' ability to deliver physical metal when Eastern buyers demanded it. As long as COMEX and LBMA inventories were adequate, Chinese buyers could purchase paper silver in London or New York, take delivery, and ship it to Shanghai if premiums justified the cost. This physical flow kept prices aligned. The breakdown began when Western inventories started depleting faster than they could be replenished. COMEX registered inventories, which stood at 350 million ounces in early 2020, fell to under 35 million ounces by late 2025, a 90% drawdown. London vaults, which held over 35,000 metric tons in 2020, declined to approximately 28,000 metric tons, a reduction of 7,000 metric tons, 225 million ounces. These drawdowns occurred because physical demand, primarily from Asia, exceeded the combination of mine production and recycling. The deficit was filled by existing inventories, but inventories are finite. As they depleted, the ability to arbitrage between paper and physical markets weakened. Eastern buyers could no longer reliably source metal from Western exchanges at quoted prices. Delivery delays extended, premiums widened, and backwardation emerged as the markets signal that immediate physical possession had become more valuable than future paper promises. The emergence of sustained backwardation in late 2025 represents the point where this structural breakdown became undeniable. Backwardation means the market is pricing physical scarcity, despite futures contracts suggesting adequate future supply. It means participants with physical metal are unwilling to sell it at futures prices because they anticipate either higher spot prices in the future or difficulty reacquiring metal if they sell now. And it means the paper market's pricing mechanism is no longer credible as a reflection of physical reality. The quantitative evidence of silver market stress is visible across inventory levels, price structures, delivery patterns, and geographic flows that collectively paint a picture of a market approaching critical dysfunction. COMEX registered silver inventories, as noted, have fallen from 350 million ounces to 35 million ounces between early 2020 and late 2025, but the rate of decline has accelerated. In 2020-2021, inventories fell approximately 60 million ounces. In 2022-2023, the decline was 100 million ounces. In 2024 alone, inventories fell by 120 million ounces. Through the first 11 months of 2025, registered inventories have declined by an additional 75 million ounces, with December data still pending. This acceleration suggests not a temporary drawdown, but a structural shift in supply-demand balance. If inventories were declining due to temporary elevated demand that would normalize, the rate of decline should slow as prices adjust and demand moderates. Instead, the decline is accelerating despite silver prices rising from 18 in early 2020 to over 24 in late 2025. Higher prices are not curtailing demand or stimulating sufficient supply to stabilize inventories. The backwardation structure itself provides critical data. As of late 2025, London spot silver trades at approximately $25.80 per ounce. 3-month forward silver trades at $24.10 per ounce. This $1.70 backwardation represents approximately 6.6% annualized. To put this in perspective, normal contango for silver is typically 0.5 to 2% annually, reflecting storage and financing costs. A 6.6% backwardation means spot prices exceed futures by more than 3 times the normal carrying cost in the opposite direction. This backwardation has persisted for over 90 consecutive trading days as of late 2025, the longest sustained period since early 1980. Historically, backwardation episodes in silver lasted days or at most a few weeks before arbitrage corrected them. The persistence of current backwardation signals that arbitrage is not functioning. Participants cannot buy cheap futures, take delivery, and sell expensive spot because delivery is uncertain or delayed. Delivery data confirms this dysfunction. COMEX delivery notices, formal declarations that a contract holder intends to take physical delivery, have surged. In 2020, total deliveries across all contract months were approximately 30 million ounces. In 2023, deliveries reached 80 million ounces. In 2024, deliveries exceeded 120 million ounces. In 2025 through November, deliveries have already surpassed 150 million ounces. But the critical metric is not just delivery volume, it's delivery timing. Under COMEX rules, delivery must occur within 3 business days of the contract's first notice day. In practice, most deliveries historically occurred within 5 days. In 2025, average delivery time has extended to over 20 days, with some deliveries taking 40 to 60 days. This indicates that registered inventories are inadequate to meet delivery demands promptly, requiring time to source metal from conversions of eligible to registered or from external sources. London data shows similar stress. The LBMA reports monthly data on vault holdings, but not on allocation requests. Asian import data provides the geographic dimension to this stress. China imported approximately 4,800 to 800 metric tons of silver in 2023. In 2024, imports increased to 5,500 metric tons. Preliminary data for 2025 suggests imports will exceed 6,200 metric tons, a 30% increase in 2 years. India's silver imports have followed a similar trajectory. rising from approximately 3,200 metric tons in 2023 to an estimated 4,000 metric tons in 2025. Combined, China and India are importing over 10,000 metric tons annually, approximately 320 million ounces. This represents roughly 38% of total annual mine production of 830 million ounces. When combined with domestic production in both countries, China mines approximately 3,500 metric tons, and India mines minimal amounts. The two nations are consuming or accumulating nearly half of global annual silver supply. These imports must be sourced from somewhere. Mine production is geographically dispersed. Mexico, Peru, China, Australia, and Russia are the largest producers, but much of this production flows through London and New York refining and trading infrastructure before reaching end users. The drawdown in London vaults, 7,000 metric tons since 2020, directly corresponds to the surge in Asian imports. Physical metal is flowing from Western financial centers to Eastern physical markets in quantities that are depleting visible inventories to critically low levels. The silver lease rate provides another quantitative signal of physical tightness. Lease rates represent the cost of borrowing physical silver for a specified period, essentially the interest rate on metal rather than money. Under normal conditions, silver lease rates are low, typically 0.5 to 1.5% annually, because silver is abundant and lenders are willing to lend it cheaply to earn modest returns. Since mid-2024, silver lease rates have surged. One-month lease rates have frequently exceeded 5% and have spiked above 10% during periods of acute demand. One-year lease rates, which historically averaged 1 to 2%, now exceed 6%. These elevated rates signal that holders of physical silver are reluctant to lend it, either because they fear it will not be returned or because they anticipate rising prices and don't want to miss gains while their metal is on loan. Industrial demand continues growing structurally. Solar panel production consumed approximately 200 million ounces in 2024 and is projected to consume 240 million ounces in 2025 and 280 million ounces in 2026. Electric vehicle production used 60 million ounces in 2024 and is projected to reach 90 million ounces in 2026. Total industrial demand for 2025 is estimated at 870 million ounces, exceeding mine production by 40 million ounces. This 40 million ounce deficit must be filled by recycling or inventory drawdowns. Recycling provided approximately 175 million ounces in 2025, primarily from electronics, photography, and industrial scrap. But recycling is relatively inelastic in the short term. It depends on the volume of silver-containing products reaching end of life, which cannot be accelerated significantly even if silver prices rise. The residual deficit, approximately 40 million ounces, not covered by mine production or recycling, must come from above-ground inventories. This is exactly what the COMEX and London drawdowns represent: visible inventories declining to fill the gap between inelastic supply and growing demand. The mathematical reality is that at current rates of deficit, visible inventories will approach zero within 12 to 18 months unless something changes. Either prices rise enough to curtail demand recycling, increases dramatically, new mine production comes online, or demand growth slows. Exchange-traded fund holdings provide additional context. Global silver ETFs held approximately 850 million ounces in early 2021 following the Reddit-driven buying surge. Holdings declined through 2022 and 2023 as investors sold. But since mid-2024, holdings have stabilized near 450 million ounces and begun increasing modestly. The stabilization and reversal suggest that at current prices, investors are shifting from sellers to buyers or holders, reinforcing rather than relieving physical demand pressure. Mining economics do not suggest imminent supply increases. Silver mining costs, all-in sustaining costs, including exploration, development, and corporate overhead, average approximately 16 to 18 per ounce for primary silver miners and 10 to 14 per ounce for byproduct production. At current prices near $25, mining is profitable, but margins are not sufficient to trigger aggressive capacity expansion, given the capital intensity and multi-year timelines required to develop new mines. Moreover, because 70% of silver is mined as a byproduct of copper, lead, and zinc operations, silver supply is largely determined by base metal demand rather than silver prices. Even if silver prices doubled, total supply would increase only modestly, unless base metal production also increased. This supply inelasticity means that balancing the market requires demand adjustment through higher prices, rather than supply increase through production growth. The sustained backwardation in silver, combined with accelerating Asian physical demand and Western inventory depletion, constitutes a signal that extends beyond the silver market itself. It reveals stress in the broader architecture of commodity markets, fiat currency systems, and the global trade and financial flows that connect them. The first layer of the signal is the breakdown of arbitrage as a price-correcting mechanism. In theory, backwardation should be impossible to sustain because arbitrageurs would buy cheap futures, take delivery, and sell expensive spot, earning the backwardation premium as risk-free profit. This activity should continue until futures prices rise above spot prices, restoring normal contango. The persistence of backwardation means this arbitrage is not occurring at sufficient scale. The reason is not lack of profit incentive. A 6.6% annualized premium is enormous by commodity market standards. The reason is that taking delivery on COMEX futures no longer guarantees receipt of physical metal within timeframes that allow profitable spot sales. If delivery takes 30 to 60 days and spot prices are volatile, the arbitrage becomes a speculative bet on price movements rather than a risk-free trade. Participants rationally avoid it. This breakdown reveals that futures contracts are no longer functioning as reliable claims on physical metal. They are functioning as separate financial instruments that trade based on different supply-demand dynamics than physical silver. The futures price reflects paper market positioning, hedge fund strategies, bank derivative exposures, speculative sentiment. The spot price reflects physical availability, vault inventories, refinery output, delivery logistics. When these two prices diverge persistently with spot above futures, it signals that the paper market has lost credibility as a mechanism for physical price discovery. Participants needing actual metal bypass, futures markets, and pay premiums in physical markets. Participants trading for financial exposure use futures because they never intend delivery. The markets have bifurcated. The second layer of the signal is geographic. Asian physical demand draining Western inventories represents a reversal of capital flows that persisted for decades. During the late 20th century and early 21st century, Western financial centers, London and New York, were net importers of physical commodities, financed through trade deficits and capital account surpluses. Western economies consumed more than they produced, funding the gap through borrowing and currency issuance. Asian economies, particularly China, ran trade surpluses, accumulating dollar reserves and claims on Western financial assets. But increasingly, these regions are converting financial claims into physical commodities, not just silver, but gold, copper, oil, and strategic metals. This represents a fundamental shift from financial asset accumulation to real asset accumulation. The shift reflects declining confidence in the long-term value of fiat currency reserves and dollar-denominated financial assets. If China believed dollars and treasury bonds would reliably store value, there would be no reason to convert them into physical silver at premium prices. The willingness to pay premiums. Shanghai silver trading 15% above COMEX, London spot trading 6.6% above 3-month forwards, signals that Asian buyers view physical metal as preferable to paper claims even at significant cost. The third layer involves central bank behavior and monetary policy context. Central banks globally have been net buyers of gold for 15 consecutive years through 2025, accumulating over 5,000 metric tons during that period. This accumulation is occurring while these same institutions manage fiat currency systems and insist that precious metals have no monetary role in modern economies. The contradiction is profound. If gold and silver are barbarous relics with no monetary function, why are central banks accumulating gold at the fastest pace in 50 years? The answer is that central bankers understand privately what they deny publicly. Fiat currency systems are fragile, and physical precious metals provide insurance when confidence erodes. While central banks don't report silver holdings as reserves, the logic driving gold accumulation applies equally to silver for private investors and smaller institutions. If the system that manages dollars, euros, and yen cannot be trusted to preserve purchasing power, then holding claims denominated in those currencies, including futures contracts and unallocated accounts, is risky relative to holding physical metal. The fourth signal appears in the behavior of sophisticated market participants. Large institutional investors, hedge funds, commodity trading advisors, family offices, are typically early adopters of strategies that exploit market dislocations. If backwardation represented a simple arbitrage opportunity with no structural risks, these participants would be aggressively taking delivery on cheap futures and selling expensive spot. The fact that backwardation persists despite the presence of sophisticated participants suggests they perceive risks in the strategy, either delivery uncertainty, counterparty risk with exchanges or banks, or regulatory risk that rules might change mid-trade as they did during the Hunt Brothers episode. This risk perception by informed participants is itself a signal that the market's infrastructure is not functioning normally. The fifth signal is the widening of premiums, not just between futures and spot, but between different forms of physical silver. Retail coins and bars trade at premiums of 15 to 30% over spot prices in many markets. Allocated silver in London vaults trades at premiums of 4 to 6% over unallocated. Shanghai Physical trades at 15% premiums over COMEX futures. These cascading premiums reflect different levels of certainty about physical possession. A buyer purchasing a retail coin has immediate physical possession, the highest certainty. A buyer holding allocated silver in a London vault has legal title to specific bars, moderate certainty. A buyer holding unallocated silver has a contractual claim but no specific bars, lower certainty. A buyer holding COMEX futures has a promise of future delivery, lowest certainty. The market is pricing this hierarchy of certainty through premium structures that widen as confidence in paper claims declines. All of these signals point to the same underlying reality. The silver market is transitioning from a system where paper and physical were treated as fungible and interchangeable to a system where physical possession carries significant premium over paper claims. This transition is not occurring smoothly or transparently. It is occurring through market stress, backwardation, delivery delays, inventory depletion, and premium expansion. History provides clear precedent for what occurs when commodity markets enter sustained backwardation, while inventories deplete and geographic flows concentrate in one direction. The outcomes are not gradual adjustments, but rapid, disruptive repricings that overwhelm existing market structures. The 1980 silver backwardation ended through exchange intervention rather than market forces. COMEX changed rules to prevent the Hunt brothers from taking delivery, forcing liquidation of long positions. Prices collapsed from $50 to $11 in weeks. But this solution did not resolve the underlying physical tightness. It simply destroyed paper demand while leaving physical scarcity unaddressed. The consequence was that industrial users faced actual shortages in the early 1980s as silver became difficult to source at any price, forcing production curtailments and accelerated substitution away from silver in some applications. The current backwardation cannot be resolved through similar rule changes because the demand is not concentrated in a single party that can be targeted. Asian physical demand represents hundreds of millions of consumers, manufacturers, and investors across multiple countries with different regulatory frameworks. COMEX can change its rules to prevent American participants from taking delivery, but it cannot prevent Chinese or Indian buyers from sourcing physical metal through London, Perth, or direct from mines. The consequence is that backwardation will likely persist until one of several outcomes occurs. The first possibility is that spot prices rise sharply relative to futures, widening the backwardation to levels that incentivize holders of physical metal to sell. This would require prices potentially doubling or tripling to overcome the reluctance to sell metal that participants view as insurance or strategic reserves. Such a price surge would be disruptive to industrial users and could trigger production disruptions in solar, electronics, and other sectors. The second possibility is that futures prices collapse relative to spot as participants lose confidence in paper contracts and shift exclusively to physical markets. This would destroy the futures market's liquidity and eliminate it as a price discovery mechanism. Industrial hedgers and miners relying on futures for risk management would be forced to negotiate bilateral contracts with physical delivery, reducing market efficiency and increasing transaction costs. The third possibility is that COMEX or LBMA declares force majeure on delivery obligations, settling contracts in cash at prices below physical market levels. This has precedent. The London Metal Exchange did exactly this during the March 2022 nickel short squeeze, canceling trades to protect short sellers. Such action would confirm that paper claims are not equivalent to physical metal and would likely trigger a permanent bifurcation between paper and physical pricing. The fourth possibility is that governments intervene through export restrictions, strategic stockpile releases, or mandatory allocations. China could restrict silver exports to reserve domestic production for domestic use, as it has done with rare earth elements. This would exacerbate shortages in Western markets and force industrial users to either pay extreme premiums, reduce production, or accelerate substitution. For industrial sectors, particularly solar and electronics, sustained backwardation and high physical premiums create immediate operational problems. Manufacturers typically hedge input costs through futures contracts, locking in prices months in advance. If futures contracts cannot be reliably converted to physical metal, hedging becomes ineffective. Manufacturers must either hold larger physical inventories, tying up capital and warehouse space, or operate without hedges, exposing themselves to price volatility. Solar panel production is particularly vulnerable because silver consumption per panel is declining due to thrifting technologies. But total consumption is rising because panel production is growing faster than thrifting can offset. Current projections suggest solar could consume 300 million ounces annually by 2027. If physical silver is unavailable at prices near futures quotes, solar manufacturers face a choice: pass higher costs to customers, reducing solar competitiveness versus fossil fuels, or absorb the costs, reducing profitability and slowing industry growth. For investors, the backwardation and premium structures create a dilemma. Holding futures contracts appears cheaper than physical metal, but backwardation suggests futures may not result in delivery at quoted prices. Holding unallocated silver appears cheaper than allocated, but premiums suggest unallocated carries counterparty risk. Holding allocated appears cheaper than retail coins, but premiums suggest allocated may face conversion difficulties during stress. The rational response is to hold physical metal despite the premium. But if large numbers of investors reach this conclusion simultaneously and shift from paper to physical, the demand surge would overwhelm available supply and force sharp repricing. This is the dynamic that creates self-fulfilling prophecies in commodity markets. The anticipation of shortage causes behavior that creates actual shortage. Geopolitically, the concentration of physical flows toward Asia, while Western inventories deplete, creates strategic vulnerabilities. If China controls the majority of physical silver available in global markets through combination of domestic production, imports, and accumulated stocks, it gains pricing power over a metal essential for renewable energy and defense electronics. Western nations become dependent on Chinese willingness to export or sell from stocks during shortages. This dependence creates leverage similar to OPEC's oil leverage in the 1970s, or Europe's natural gas dependence on Russia in the 2020s. In each case, the resource-controlling region can extract geopolitical concessions or economic advantages by threatening supply restriction during crises. Silver is not as critical as oil or natural gas to basic economic functioning, but for specific strategic industries, semiconductor fabrication, advanced solar, military electronics, it is essential and substitution is difficult. Historical precedent from the 1970s oil shocks shows that commodity supply disruptions trigger multiple cascading effects. Inflation, as higher input costs flow through supply chains, political instability, as populations face reduced living standards and strategic realignments as nations seek alternative supply sources or substitutes. The silver market is much smaller than oil markets, so the macroeconomic impact of a silver supply crisis would be more limited. But for specific sectors, the impact would be acute and immediate. The final historical lesson is that commodity market stress tends to coincide with broader financial system stress. The 1980 silver backwardation occurred during a period of double-digit inflation, currency instability, and loss of confidence in fiat money. The oil shocks of the 1970s occurred during the breakdown of Bretton Woods and the emergence of persistent fiscal deficits. Commodity dislocations are both symptoms and causes of broader systemic instability. Current conditions, rising government debt, persistent inflation despite rate increases, geopolitical fragmentation, and declining confidence in dollar reserve status resemble the macroeconomic environment of the 1970s more than any period since. Silver backwardation in this context is not an isolated market anomaly. It is an early warning signal that physical commodity, scarcity, and fiat currency abundance are creating tensions that existing market structures cannot manage. In 1980, silver backwardation signaled that participants no longer trusted the system to deliver metal against paper contracts. The response was not to honor delivery demands, but to change rules to prevent them. The backwardation disappeared, but the underlying shortage persisted for years, manifesting in industrial supply disruptions and sustained high prices. Today's backwardation is different in scale and context. It has persisted for over 90 days, longer than any episode except 1980. It is occurring while Asian demand drains Western inventories at over 200 metric tons monthly. It is happening in a macro environment of currency debasement, geopolitical fragmentation, and declining confidence in financial system integrity. The spot premium over futures, approximately 6.6% annualized, is not a temporary aberration. It is the market's signal that immediate physical possession is worth substantially more than promises of future delivery. The premium exists because participants doubt those promises will be honored, or because physical supply is so scarce that possession has strategic value beyond price. This is not a prediction of what will happen next week or next month. It is an observation of conditions that historically precede rapid, disruptive repricings, backwardation that persists for months while inventories deplete and physical flows concentrate in one direction does not resolve gently. It resolves through crisis, either shortage that forces price surges, or default that forces cash settlement, or intervention that forces rule changes. The mathematics are clear. COMEX inventories at 35 million ounces can support perhaps 4 to 6 more months of deliveries at current rates, before reaching levels where normal operations become impossible. London vaults, already down 7,000 metric tons, cannot sustain outflows of 200 metric tons monthly indefinitely. Asian imports exceeding 10,000 metric tons annually cannot be sourced from mine production of 25,000 metric tons globally without someone, somewhere, experiencing shortages. Something has to give. Either prices rise enough to curtail demand and stimulate supply, or delivery systems fail and markets bifurcate permanently between paper and physical, or governments intervene to allocate scarce supply. None of these outcomes are gentle market adjustments. All represent disruptions to existing structures and expectations. The backwardation is the signal. The inventory depletion is the confirmation. The geographic concentration of flows is the acceleration. What remains unknown is only timing, not whether the system is under stress, but when that stress exceeds the capacity of markets and institutions to manage it. History suggests that when it snaps suddenly, and it has just begun to crack.